Welcome to my lecture on FASB ASC Topic No. 250, Accounting Changes and Error Corrections. In this lecture, I will break down this complex topic in layman's terms, ensuring that you grasp the important concepts and their practical applications. I will also use real-world examples to illustrate the key points. Imagine you're running a business and you've been using the same accounting method for years. Then, one day, you decide to switch to a different method. This is called a change in accounting principle. There are two main types of accounting changes: mandatory changes. These are changes that you are required to make by law or by accounting standards. For example, he issues a new accounting standard that requires you to change your method of accounting for inventory. You would be required to make a mandatory change. Voluntary changes. These are changes that you choose to make on your own. For example, if you decide that a different accounting method would be more appropriate for your business, you could make a voluntary change. In general, you are not allowed to make accounting changes unless the new method is preferable to the old method. This means that the new method must provide more relevant and reliable financial information. However, there are some exceptions to this rule. For example, you are allowed to make a change to conform with a new law or accounting standard. You are also allowed to make a change if the old method is no longer practical. There are two main ways to account for accounting changes. Retrospective application. This is the most common method. It involves applying the new accounting method to all prior periods. This means that you would have to restate your financial statements for all prior periods as if you had been using the new method all along. Prospective application. This method is only allowed in certain cases. It involves applying the new accounting method only to the current period and future periods. This means that you would not have to restate your financial statements for prior periods. An error is a mistake in the accounting record. Errors can be caused by a variety of factors, such as fraud, negligence, or miscalculations. Errors should be corrected as soon as they are discovered. The correction should be made by restating the financial statements for all prior periods affected by the error. Let's say that you've been using the FIFO, first in, first out method of accounting for inventory. However, you realize that the LIFO, last in, first out method would be more appropriate for your business. This would be considered a voluntary change in accounting principle. Let's say that you discover that you have been overstating your inventory by 100,000. This would be considered an error. You would need to correct the error, restating your financial statements for all prior periods affected by the error. When you make an accounting change or correct an error, you are required to disclose certain information in your financial statements. This disclosure helps users of the financial statements understand the impact of the change or correction. The specific disclosure requirements will vary depending on the type of change or correction. However, in general, you will need to disclose the following information: the nature of the change or correction, the reason for the change or correction, the effect of the change or correction on your financial statements, any other information that is relevant to the change or correction. Accounting changes and error corrections can be complex topics. However, by understanding the basic concepts and applying them correctly, you can ensure that your financial statements are accurate and reliable.